Imagine spending over 25 hours digging through reports from Vanguard, Fidelity, BlackRock, and more just to get the real story on the markets. That's exactly what my team at Nexus did for this outlook, so you don't have to do the heavy yourself. Today, we'll unpack things like the Fed's helpful rate cut, moderating inflation, and normal year-end adjustments. What's going on, guys? I'm Robert Montez with Nexus Wealth Management, and today we're breaking down what moved the markets this past December, as well as two takeaways to start your 2026 off strong regarding your expenses. Overall, December was a steady month, closing out a resilient year with some gentle holiday chop. The S&P 500 was essentially flat, the Dow gained 0.7%, and the Nasdaq did 0.5%. All of these indexes finished near record highs, though, for 2025. As far as positive factors last month, these three things really stood out. First was the Federal Reserve's 25 basis point rate cut. This rate cut lowered borrowing costs, reinforced economic backing, and lifted confidence in stability and growth. Second, inflation continued to trend down, ending the year at around 2.7%. This is a positive, resilient sign that aligns with the Fed's efforts to guide inflation gently back towards their 2% target. Third, consumer staples held strong. Consistent demand for everyday essentials gave portfolios a stable, reassuring buffer during the month. Now, on the flip side, here are three things that created a little pressure last month. First, investors sold large amounts of tech stocks like Nvidia and Tesla to lock in their impressive gains. This is a totally normal and expected move after such a fantastic year for tech as investors rebalance portfolios and they move into 2026. Second, were much thinner holiday trading volumes. With many traders on vacation and institutions in holiday mode, volumes on many days dropped to half their normal levels. This low liquidity amplified some of the gentle chop and exaggerated daily swings, but is completely typical for December. Third was caution around high-tech valuations in a softening job market. Unemployed rose modestly to 4.6%, with hiring slowing a touch. Yet this brief hesitation was offset by strong company basics and a resilient economy. Guys, as someone who's right there with you, juggling work, family, and everything else, here are my two quick takeaways. First, check your diversification. If you're heavily invested in US large caps like the S&P 500, adding bonds, small caps, or international shares can help smooth that ride out long-term with your overall portfolio. Second, schedule a time to connect with your financial advisor in Q1. Share any life changes or big plans on the horizon so they can confirm your plan is still on pace to accomplish what you're after. And whether you're a busy professional, a mom balancing career and home, or just want a fresh set of eyes on your portfolio, or perhaps to help benchmark your company's 401k, reach out. My team at Nexus would love to help you build a plan that lets you thrive with more confidence. Drop me a message anytime. Thanks for watching. We'll see you guys next week.